Hello everyone, welcome to my channel again, Think, Learn, Grow. In this video, we are going to discuss few financial terms that you would listen on daily basis. These terms are common, have significant impact on our day-to-day life. So let's get started.
Number one, budgeting. A budget is a financial plan to control future operations and results. Budgeting means giving every rupee or dollar a job before you spend it. It's basically a plan for your money.
Let's understand budgeting with a simple example. Imagine Ali earns 100,000 rupees every month. Instead of spending randomly, he follows the 50-30-20 budgeting rule. Here's how it works. 50% goes to needs, 30% goes to wants, and 20% goes to savings and investing. So out of 100,000 rupees, 50,000 rupees go to essential expenses like rent, groceries, transport, electricity, and internet bills. Then 30,000 rupees are used for wants, things Ali enjoys but doesn't absolutely need, like eating out, shopping, entertainment, and hanging out with friends. Finally, 20,000 rupees go into savings and investments. Some money goes into an emergency fund, and the rest is invested for the future. Instead of wondering where the money went, Ali controls his money with a simple plan. Without a budget, money disappears fast. With a budget, you control your money instead of wondering where it went. Compound interest. Compound interest is interest calculated on both your original amount and the interest you've already earned. Compound interest is one of the most powerful concepts in finance. It means you earn interest on your interest. Think of it like a snowball rolling downhill. It picks up more snow as it grows, and the bigger it gets, the faster it grows. You don't add anything extra. The growth feeds itself. The longer you leave your money invested, the faster it grows. That's why people call compound interest money making money. Liquidity. Liquidity means how quickly you can turn something into cash. Imagine you own a beautiful house worth 500,000. Your bill is due tomorrow and you're $1,000 short. Can you pay it? Technically, you're worth $500,000, but you can't access that money overnight. That's a liquidity problem. Being rich on paper doesn't mean you can pay your bills today. Liquidity is how quickly and easily an asset can be converted into cash without losing its value. The easier it is to turn something into cash, the more liquid it is. The harder it is, the less liquid. Think of liquidity like the state of water. Now, cash is equals to water already liquid, ready to use instantly. Savings account equals to slightly frozen water, takes a little effort, but converts fast. Real estate equals to ice, solid, valuable, but you can't pour it. It takes time and effort to melt it into usable cash. The more frozen your assets are, the less liquid you are. The more liquid an asset is, the easier it is to access your money during emergencies. Emergency funds should stay liquid.
Inflation. Inflation is the gradual increase in the price of goods and services over time, which means the purchasing power of your money decreases. In simple terms, the same amount of money buys you less than it did before.
For example, a burger that cost $3 a few years ago may cost $5 today. If your money sits idle while prices rise, your purchasing power decreases. Economists measure inflation using the Consumer Price Index, or CPI. The CPI tracks the price of a basket of common goods, food, housing, transportation, healthcare, and measures how that basket's cost changes over time. If that basket cost $1,000 last year and $140 this year, inflation is 4%, meaning your money is worth 4% less than it was 12 months ago. Not all inflation is the same. There are three main causes. Demand pull. Inflation, too much money chasing too few goods. Economy is booming. Everyone is spending. Prices get pulled up. Think of concert tickets when everyone wants to go. Prices skyrocket. Cost push inflation. When production costs rise, companies pass that cost to consumers. Oil prices spike, shipping costs more, everything in the store costs more. The price is being pushed up from the supply side. Built-in inflation, workers expect prices to rise, so they demand higher wages. Higher wages increase production costs, which raises prices again. It becomes a self-fulfilling cycle. These were the basic financials terms that everyone should know about. Thanks for watching. See you in the next video with more basic concepts to boost your knowledge. Please subscribe to the channel.